Welcome to the Deep Dive. Today, we're looking into some interesting investment moves in media entertainment.
That's right. We're focusing on Disney and Comcast, specifically why one investor at the Motley Fool decided to buy more stock in both recently.
Okay, and we're working off an article from the Motley Fool, published May 2nd, 2025.
Yep, exactly. It's called 3 Reasons Why I Bought More Disney and Comcast Stock Last Week.
Got it. So our mission today is really to unpack that thinking, right?
Yeah.
Understand the why behind buying these two, especially given some of the, narratives out there.
Precisely. We want to give you a shortcut to understanding the key factors that this particular investor found compelling.
All right, let's jump in. The first point the article makes is about stock prices being historically low.
Yeah, it notes that both Disney and Comcast stocks are trading lower now than they were 1, 3, even 5 years back.
Which feels a bit weird, doesn't it? Because these companies have actually been growing their revenues.
It does seem counterintuitive. The article points out Disney's revenue is up 31% compared to fiscal 2019.
31%, wow.
And Comcast is up 13% over that same period.
Okay, so revenues are up. What about profits?
Operating profits are also higher for both companies during that time.
So more money coming in, more profit being made, but the stock price is lower.
Exactly. That's the core of the first argument. The investor sees them as, well, historically cheap compared to how the businesses are actually doing.
Right. Does the article give any specific numbers on valuation, like price to earnings or anything?
It does. For Comcast, it mentions it's trading at less than 8 times this year's projected earnings.
Less than 8 times. That does sound low.
And only 7 times next year's target.
Okay. And Disney, I imagine it's higher.
It is higher, yeah. Around 17 times for the current fiscal year, which ends in about 5 months from when the article came out, and 15 times for fiscal 2026. But the key point is, even though they're higher than Comcast's, these multiples are still at the low end of where Disney has traded over the past decade.
So for both, the argument is the market might be sort of undervaluing them right now.
That seems to be the investor's take, yes.
Yeah.
A disconnect between the stock price and the underlying business fundamentals.
Okay, that makes sense as a starting point. What's the second reason? The article mentioned something about cash cows.
Right. This is really interesting. It talks about cash cows fueling growth initiatives.
So using stable parts of the business to fund the future.
Exactly. Both companies have these big, mature segments that, while maybe not growing super fast anymore, generate a lot of cash.
Okay, break that down for Comcast first. What's their cash cow?
For Comcast, it's their connectivity business. So think cable TV and broadband internet.
Right, the traditional stuff,
Mm-hmm.
which is facing challenges, obviously.
Yeah, cord cutting is real. Broadband growth is slowing down a bit. It's their largest segment, but it's gradually declining or plateauing.
But still making money.
A lot of money. It throws off significant cash flow. And Comcast is using that cash pretty strategically.
How so?
Well, they're buying back stock, which helps shareholders. They're paying a dividend, which the article notes is getting close to a 4% yield.
Wow, almost 4%. That's attractive for income seekers.
Definitely. And critically, they're pouring money into growth areas, content, their theme parks, and also their wireless business.
So using the reliable cash from connectivity to bet on parks, content, and wireless. Makes sense. What about Disney? Similar story.
Very similar dynamic, yeah. For Disney, the cash cow has traditionally been its linear networks like ESPN, ABC, FX, those channels.
Also facing cord-cutting pressures, I assume.
Absolutely. Same challenges, but again, still generating substantial cash. And what's changed more recently for Disney, and this is important.
What's that?
Their streaming business, Disney+, Hulu, ESPN+, has actually turned profitable as a combined unit.
Oh, right. That was big news.
Huge! So now they have that contributing cash too, or at least not draining it anymore. This gives them even more capital to reinvest.
And where are they putting that capital?
Primarily into their theme parks, which are huge performers, and of course into creating more content for both streaming and theatrical. It mirrors the Comcast strategy, really.
So both are leveraging these established, maybe slower growing, but very profitable parts of their businesses to fuel the next wave.
Precisely. It shows how these big, established companies can adapt and pivot, using their existing strengths to fund new opportunities.
Okay, this brings us to the third point, which ties into those theme park investments, especially for Comcast, the whole Epic Universe situation in Orlando.
Right. The article tackles this narrative head-on. The idea that Comcast's new park, Epic Universe, could be a Disney killer.
Yeah, I've definitely heard that phrase thrown around. What's the counter-argument here?
Well, the investor looks back at history. Remember when Universal opened Islands of Adventure back in 1999 right next door to Universal Studios Florida?
Vaguely, yeah.
The thinking then might have been similar. Maybe it would hurt Disney World, but the article argues it didn't really work out that way.
What happened instead?
It arguably just made Orlando an even bigger, more compelling tourist destination overall. It grew the whole pie.
Interesting. So more competition actually led to more visitors for everyone.
That's the suggestion. Yes, Disney responded over the years with amazing new rides. Think Flight of Passage, Rise of the Resistance, Cosmic Rewind. Those came between 2017 and 2022.
Right. Massive investment.
Huge investments. But Universal Orlando kept doing well, too. So the idea is that Epic Universe might do the same thing, bring more people to Central Florida, benefiting everyone.
Okay, that's a different take than just direct competition.
Yeah.
What about Epic Universe itself? The article mentions previews.
Yeah, it touches on the early previews. It calls the park a glorious celebration of next-gen ride technology and praises the jaw-dropping eye for detail.
Sounds pretty impressive.
I sense a but coming.
Well, it does acknowledge some potential, let's call them growing pains, seen in the previews. Things like long waits for the big rides and even for food.
Even during previews with limited crowds.
Apparently, yes.
Yeah.
The article described the preview crowds as like water park-sized crowds in the thousands, and they were already seeing bottlenecks.
So the big question is, how will they handle potentially tens of thousands when it officially opens on May 22nd? That's the million-dollar question. Operationally speaking, it's a huge challenge.
Does the article see that as a major negative for Comcast?
Not necessarily. It frames it more as evidence of incredibly high demand. High demand, even with some initial bumps, isn't really a bad problem to have in the long run.
True. And the thinking is people drawn by Epic might spill over elsewhere.
Exactly. Comcast has its other parks right there. Universal Studios, Islands of Adventure, Volcano Bay to help absorb crowds.
Right.
And the argument is that Disney World and even the smaller parks like SeaWorld will likely benefit too from just having more tourists in town overall.
So the competition drives innovation and maybe lifts all boats.
That seems to be the investor's perspective presented in the article. It's less winner takes all and more a rising tide lifts all theme parks, perhaps.
Okay, so let's recap the investor's logic here for buying more Disney and Comcast.
Sure. So number one, the stocks look historically cheap compared to their actual business performance, like revenue and profit growth.
Got it. Undervalued.
Number two, both companies are smartly using cash generated from their mature businesses' connectivity for Comcast, linear networks, and now streaming for Disney to invest in future growth, like parks, content, and wireless.
Okay, strategic reinvestment.
And number three, the Orlando theme park market, specifically with Epic Universe coming, is seen not as a zero-sum battle, but as an expanding market where both Disney and Comcast can thrive, potentially boosting overall tourism.
Right, challenging that Disney killer idea.
Exactly. So putting it all together, this investor sees both as compelling buys, looking past some short-term noise or competitive fears to the underlying strengths and long-term potential.
It's a fascinating perspective, especially seeing both companies through a similar positive lens despite their competition.
It really emphasizes the diversification and adaptability within these media giants.
This has been really insightful. It makes you think about how these big established players navigate change. So as we wrap up, what are maybe one or two key things you, the listener, might want to watch going forward to see if this investment thesis plays out?
That's a great question to ponder. I'd say definitely keep an eye on the streaming profitability for both. Can Disney sustain it? Can Comcast's Peacock continue to improve?
Okay, streaming metrics. What else?
Theme park performance is obviously huge. Watch attendance, yes, but also per capita spending. How does Epic Universe actually impact Disney World's numbers and Universal's own overall results once it's fully open?
And how they manage those potential capacity issues at Epic.
Absolutely. And maybe more broadly, how effectively do they manage the ongoing decline or transition in their legacy businesses, like cable networks? It's about balancing the old with the new.
So lots to keep track of. It's about watching how these giants use their current strengths to build their future, and which numbers really tell that story.
Well said. It's about seeing if that execution matches the potential this investor sees right now.